So welcome back to Questions, Answers, and Solutions. I'm your host, Jameer Hayward, and I have two guests before me, that being Greg McCain and Marlon Phillips. We will have Corey Poirier joining in on the phone line and momentarily. I just want to give a shout out to my number one supporter who's always in the house, Todd Taylor, and I want to give a shout out to the engineer for the night and just say thank you so much to FLO Empire Radio for having me every single Tuesday night at 8 p.m. As you saw earlier today, tomorrow marks our 1 year anniversary for being on the radio for a year, and I think that is amazing. The time has definitely progressed well. And I'm very thankful for this opportunity and all the wonderful guests who have shared their opinions and facts with us on Questions, Answers, and Solutions. If you're tuning in tonight, you can tune in to buildingsafercommunities.com/radio, and or you can call into 929-227-4646 to simply ask questions, make a statement, or just join the conversation. Your opinions and facts are always welcome. On another note, I just want to send out my condolences to Bonnie's family as well as Serrano's family. Sending positive waves your way. Okay, so that kind of took me for a loop a little bit, but again, sending positive waves to the families. So Greg, I want you to introduce yourself.
My name is Gregory McCann, friend of Todd. I appreciate the reference to come here tonight. The topic being personal finance and all things financially related. It's of interest to me, and I always like to learn more. It seems like the kind of thing you have to learn about pretty much forever. So I work as a court officer in Brooklyn, and I've been a Brooklyn resident all my life. It's good to be here tonight.
Okay, thank you for being here with us. Marlon?
Oh, thank you everyone. Wow. FLO Empire, thank you again for having me on the show tonight. My name is Marlon Phillips. I'm the principal broker, life and health broker for Partners in Truth, based in the Bronx. And I'm just really excited to be here once again to talk about financial literacy, which is a topic that is extremely important to everyone, especially, our communities. So thank you again for having me.
Anytime. So I want to go right into a question that one of my cousins, his name is Ronald, he posed on Instagram earlier. And that question was, of course, pertaining to the topic, financial literacy. And I guess it was a statement based on the fact that people should be less focused on Trump and the presidency and more focused on building their financial empire. Brandon, I hope I'm saying that correctly. All right. So what do you guys feel about that? Anybody can take this.
Oh, yeah, sure. Well, the bottom line is you definitely do not want to focus on, the president. Okay. The president does not determine your financial success. You ultimately determine your financial success with the decisions that you make financially, with the issues that you decide to place into your household. Meaning, if you focus on the negative stuff, if you focus on bringing in foolishness, if you focus on spending money on entertainment constantly, if you focus on buying materials that have no value, it's going to bring down your financial house, period. You have to build a strong foundation, and building a strong financial foundation is like building a house. It starts off with protection, then going into, building an emergency fund, debt management, investments. You can do them one at a time or you can do them all together. Mm-hmm. But initially the focus is your financial structure. The president has his own thing going on. He has much to do, with all due respect, to running this country, and whether you like his politics, his personality, it doesn't matter. His job is just what it is. It's a job. It's a job to lead the country, one of the greatest countries in the world, if not the greatest, to lead the country to the next, I guess you could say the next century or next millennia. Mm-hmm. Our job is to build our families to the next millennia.
That's right.
So if we don't stop focusing on issues that don't even matter, then all it's going to do is just hinder us and hinder our family success. So,
Okay. Greg, you want to add?
I think my theory on most things White House related, regardless of who's actually there, the policies are going to generally remain the same. If you're a small business owner, if you're someone who wants to accumulate assets, or someone who has a goal in life to produce something that is needed by society, they may not always stand with you. They may attempt to take some of that success, maybe to deprive you of some of the benefits of that, or at least to regulate and to get involved in nuances of how you can operate that business. So I'm sure we'll talk more about that, but essentially that branch of government is probably not going to be the entrepreneur's best friend. So
I like the way that was stated nicely. You want to add to that, Marlon?
well, you know what? I'm going to agree, and on a certain aspect also partially disagree. Each branch of government has their own thing. Whether you're a Democrat, whether you're independent, whether you're a Republican, and some people say, well, Republicans are more for the wealthy, right? That's what some people say, and some people say the Democrats are more for the poor folk, right, quote unquote. And independents are just for independent. They kind of swing either way. The way I look at it is this: each party represents an ideal, and not every ideal is going to fit with everyone in that party. Okay, now myself, don't everyone shoot me all at once, right? Being a brother, I happen to be a Republican, and that was just by chance. From being in the military, it was just kind of tossed at me. You're a Republican. This is what you are.
So was that where'd that decision come from?
Honestly, I look back at it, I don't even know. I just kind of stuck with it.
That's honest.
Yeah, I honestly don't even know. I just kind of stuck with it, But I didn't make my decisions whenever I voted or whenever I look at a specific leader, whether it be in the Senate, the presidency of the United States, vice president, what have you. I didn't make any decision based off of the party that I was in, especially when it came to financial decisions.
Right.
Obviously the tax cuts or tax increases had something to do or had an impact with my business, or even how much money I made per year. All I did was re-strategize.
Okay.
And once you start getting caught up in all of those politics, now I'm not saying don't get into politics. If that's what you want to do, then fine. But don't get caught up in the politics. Allow yourself to adapt. As long as you adapt to the situation, you adapt to your environment, you'll become better for it. You'll be able to progress.
Okay. All right. Greg?
Well, in the overall sense, I probably couldn't agree more. Basically, what you're dealing with is changing environments. What are you going to do to react in the short term, I guess? That's a tough question. And I think what it brings to mind is how many of these things are symptoms and how many of them are the actual situation,
Okay.
In other words, even the administration itself, is that a byproduct of something else, an environment that's changed? This is the end result of something else, I feel like. So, that stuff is relevant. And tax cuts.
Okay.
Yeah.
All right. So when we speak about financial literacy, it's not in politics. When we vote and things like that, it doesn't. How does politics relate to financial stability?
Oh, well, that's a question that I think even most of my clients try to pry out of me, and I guess I'll finally answer the question. Usually I try to avoid answering that question, but
I was trying to find a different way to ask the question without just coming out and asking it, but I said trying to figure it out. I was going through too much processing in my brain, so I just asked directly.
No, that's perfectly fine.
Okay.
Politics, I mean, it's like being in the entertainment world on I guess you could say reality TV. Okay, it's a show. But it does play a huge impact on your financial decisions.
Okay.
An example, right? I think I've mentioned this on the show before. A couple of years ago, the Senate got together, all 127 of them, and decided to have a vote. And they wanted to vote whether or not to tax the 7702 plan, right? Which is a tax code. And for those of you that don't know, all you have to do is just look it up, what it is. And that vote could have ultimately destroyed most people's financial foundations.
Wow.
Almost instantly, right? For those of you, again, if you don't know what the 7702 tax code or 7702 plan is, I'll just give it to you. It really refers to life insurance, you know, and not surprisingly, it was a unanimous decision, no, right? Because, I mean, that particular product or that particular plan and tax code also acts as a tax shelter for many people. So, especially the wealthy.
And that's because there are different types of life insurance policies, correct?
Correct.
Okay.
Correct. And it is a very essential part to proper protection in your financial foundation. Building a good, solid financial foundation. It is for many people a lifesaver if you know how to use it correctly. So, does politics have a direct impact? Yes and no.
Okay.
Okay. That would be my official answer.
Okay. Greg?
It's a deep question. There's no doubt. For me, it's hard to say. I guess in the overall sense, it depends on your values. You know.
Okay.
How
So
you value
what are
things.
some of your values? Let's speak from that perspective.
In terms of financial literacy,
Yeah.
what you can, I guess, the true definition of wealth, in my opinion, is how long you could exist with your current expenses without having to bring in any income at all. And for some people, that's generations. You know, must be nice.
Yeah.
But for most people, it's, you know, a number of days, a number of months or weeks. So like the foundation of wealth is basically how long you can go without working, for me.
Right.
So a lot of,
Makes a lot of sense.
yeah, again, from a financial perspective. Now, when you talk about, you know, children or family, that's an asset of a different category entirely. There's no comparison. But in terms of financial experience, I was not a life insurance fan. That's just me. I'm not, you know, certainly giving financial advice, but my perspective was that you buy term life insurance, whatever that costs, that's a short-term protection, and then you invest the difference. Whatever that difference might be that you can save, invest it in things you believe in.
Okay.
Which, excuse me. Often means investing in things that you spend your money on. Certainly consumer products, but even more long-term strategies. For example, if you look at a presidential administration, maybe it's clear that some of the values of that administration will align with defense contractors. Some of the values of that administration will align with infrastructure companies, concrete companies, steel. The price of commodities will be affected. These things are so predictable that it's almost like the easiest form of speculating, because of, in a sense, what you know is coming in terms of a wave of popular opinion or economic forecasting, or whatever the case may be. So again, that's my perspective on, I guess, the political environment. It's an indication. It's a symptom. And it can tell people things they need to know in terms of like long-term stability or perhaps where their assets should be focused. But the primary thing is bringing in more than you spend. That's the hardest part.
Okay. And I think I heard everything that you said, but I think the most that I pulled out of that was when you initially said that, I'm going to reword it differently, being able to survive without outside income, meaning, I guess, you've worked for X amount of time, you've saved up enough money, and you're able to live at least a year. You said a day, week, maybe months without, but I say a year without, I guess, government support, or without being in debt, or
Selling your
foreclosure,
time.
or
selling your time,
selling your
your
time,
property,
your
items.
property assets, right? How's that looking for us?
Well, I can.
Because I'm all about that. I'm all
Right.
about that, being able to, God forbid, if something were to happen, making sure that myself and my family are secure and I'm able to take care of them without working. That sounds good.
Well, you know, that's called residual income or recurring income.
Okay.
Now, that is huge because ideally, you know, even in Partners in Truth and with the partners that I work with and the individuals that I train and teach and coach, we often tell people you need to make more money. That is a solution pretty much to everything, right? Doesn't matter what product you put your money into. Now, I understand, you know, it was just said that, you know, buy term, invest the difference. But I always say no life insurance is bad life insurance. I'm just not a big fan of buying term and invest the difference because not everyone can do that. Not everyone has the discipline to invest the difference.
Okay.
So,
But it's not a bad idea. It's
No, it's
actually a
not.
good idea, but it's based on preference and lifestyle.
I would say yes.
Okay.
Yes, it definitely. I wouldn't say it's a spectacular idea. It's a great idea, but it's good for those who are, for lack of better terminology, pretty anal about
Okay.
their finances and watching the market.
Sound like you,
constantly.
Greg?
So,
I know
like-
the price of Brent crude most
Yeah.
days.
yeah. So I mean, yeah. Well, if you're a trader,
Mm-hmm.
but and you do this, whether you do it for fun or you do it as a career,
Mm-hmm.
definitely. You know, I've been dabbling in that myself, and I tell you, it's a little bit annoying having to look at the market all the time. But I'm enjoying it. You know, I'm enjoying it. But I'm definitely a huge advocate for permanent life insurance, and also and other types of products as well. You know,
Okay.
like your IRAs and whatnot. But that's another story for another time. But when we're talking about residual income, that is huge. You know, again, like I said, everyone's biggest problem is just making more money. Now, the way you do that, whether it's trading, whether it's getting another job, trading your time for dollars. Not that I would say everyone should do that because not everyone can do that either. You know,
Right.
not everyone is built like that. You know, it might be preferable for you if you go and do something like a home-based business or you do some freelancing, whatever your flavor is to make extra money, as long as it's legal, obviously. You want to be able to make more money. You want to be able to save and stack that money. And when I'm talking stacking that money, I'm talking about when you get the money, pay yourself first. That's ideal. That is
Yes.
ideal. I don't care if you're a trader on Wall Street or if you sell health insurance, life insurance, if you're walking around selling soaps and or whatever it is, that extra money, don't just take it and start throwing it to Uncle Sam and start paying all your bills off right away. Now, I'm not saying don't pay your bills. Okay, definitely pay your bills. But you don't want to just take all that money and throw it into places where your money's not working for you.
Right.
You know, and that's something that is continuous with the society, especially in the lower income, middle income families and communities. I mean, they take their money and they're just kind of throwing it away, and it's not working for them.
And not only, and I don't want to, generalize, but not only are some people throwing their money, paying their bills and things like that. And as you mentioned, that is very essential. You're supposed to pay your bills and on time, of course, but they're wasting their money on things that are materialistic and not really worth, as you said before, any value. I think we have a call on the line. Is there caller, you on the line? Hi, caller, are you on the line? Okay, well, if you can hear me, you can just dial us back at 929-227-4646 or tune in to buildingsafercommunities.com/radio. Okay, so let's continue. I want to know what that looks like for, I'm just going to make up a family size here. So you have a husband, you have a wife, you have 2 children and a dog. Okay, so when we speak about financial literacy, how does that family maintain with 2 incomes, right? So the husband and the wife are both working. You have the children, let's just say one is in college, the other is in middle school. They own a home. How do they build from there?
Well, you know what? That's an excellent question. Thank you for asking that.
1 minute. Caller, you on the line? I'm sorry, Marlon. Hi, caller. Who am I speaking with? I'm not sure if there's an issue with the line. Hi, caller. You on the line?
The mic is turned off. They hung up.
Okay.
Scared.
They'll call back. They'll call back. Yeah.
Don't worry, we still.
They have to be diligent, right? Just keep calling back. Okay. So how does that look? And let's just say, as a matter of fact, let's just take out the home. They don't own a home yet, and they want to own a home. And let's just say, let's bring in income. The husband makes, let's just say, $75,000 a year. The wife is somewhere in the $45,000 a year. Is that okay? Or should it
That's
be a little
fine.
bit higher than that? Because
Well,
you
how
guys
come-
are looking.
Well, how
Greg,
come I can't make more than the husband? I mean, come on, you know. You gotta
What
be
the
politically
husband?
correct here.
Right, the husband. Okay, so we're going with the husband. Did I say what I said? 72 or 75?
75.
Okay, 75 with the husband, and between 40 and 45 with the wife.
If she's in HR, she's making at least 90. If they're in Brooklyn, they're each making at least 70, right? I mean, this is, I think I understand
But
where
I
you're
want to
going.
start off. I'm sorry to cut you
Yep.
off, but I wanted to start off with something that's really like a little bit lower, for strategical purposes, because a lot of people who watch the show, our viewers and supporters, some of them are making 45,000,
Mhm.
some of them are making 75,000. Two family homes. So I wanted to keep it in a range that's a little reasonable, right?
Right.
My blood pressure went up as soon as I heard the scenario. I'm like, oh, okay, here we go. This is, everybody's fighting.
I made it a little tough.
I'm gonna try to take this one. Well, initially, you want to sit down and you want to number one, understand where all of your expenses are going.
Okay.
And I know, when I sit down with a client, I do what's called a financial needs analysis. We want to see where all of your money is being spent.
Mm-hmm.
Now, ideally, you don't want to be spending more than you're bringing in. But unfortunately, that's almost everyone. They're spending more than they're bringing in. So we're going to, and we're going to look at your rent or mortgage. We're going to look at how much you're spending for education, if you're spending any education money for your children, your tax return. We're going to look at projected income over the next 5 to 10 years, possibly. We're going to look at whether you have any insurances like life insurance or health insurance that you're paying for, how much you're actually paying for. We're going to be looking at, whether you have pets or not, because
Well, yeah, I said
Yes.
a dog. They got a dog.
One dog.
okay, so one dog, right? So
And
we
the
have-
dog has life insurance
okay, fantastic.
and medical insurance.
There you go. As well they should.
Yes.
So we have this family now. 75,000, 45,000.
Yeah, 45.
Right? 45,000. A dog, child, rent. We want to make sure that this family is putting away at least, if we add that up about 75, 45, at least about close to a third of their own income. At least, if they can. So we're talking about 5%, 10% of total income from each person adding it together. It'll still be about 5-10% if you add it up. But we want to make sure that we're putting this away annually and then divide it up per the month.
Okay.
Okay, so that's the first step to paying yourself first. If they can't afford 5 to 10%, you can go with 2%. Every little bit helps, right?
Right.
Take it, stack it, keep putting it away. Now,
So let me just intercede just a little bit and talk about a little bit about savings accounts, because they say I've heard that you don't get what you top dollar for opening up a savings account. Your money doesn't grow, but I think some light has been shed a little bit with you saying, okay, open up, put this aside for savings. So are you saying open up a savings account and put it in the bank, or put it in your safe at home?
no, you want to put it in the bank. You definitely want to put it in the bank. I don't want anyone to get the idea that banks are terrible.
Okay.
Right? They're not. But most people put their money in the bank assuming that it's just going to magically grow somehow, right? And when we come out of high school or we get our first job, we're like, yeah, I got paid. I'm going to take this money, I'm going to throw it in the bank, and it's just going to sit there and grow. But the bank in a regular savings account is less than 1%. So you got to put your money into something that actually is going to cause it to grow. And our professional trader here can definitely attest to that. You want to put your money into things like maybe a stock, right? A stock that's, most stocks are not sure things as far as I know. I've never heard of a stock that's an absolute sure thing. But you definitely want to put it into something of that nature where it's going to grow rapidly. You also want to probably look at something that's going to save you more money, or at least have a fixed interest rate. Something like, let's say, definitely permanent life insurance.
Okay.
You also probably want to put it into something like a Roth IRA.
But whole life is better than.
Well, it depends on what your preference is.
Okay.
Whole life is fine. Whole life is fine, but even on that, you're not guaranteed the 4% that they're gonna give you. You're guaranteed a 0% floor, which basically means you're not gonna lose any money. And IUL is better. It's a little bit more flexible as opposed to a whole life, because a whole life is more the monthly premium is pretty much more permanent. Like if you're gonna pay $1,200 every month for a whole life, you're paying $1,200. You can't
Right.
pay any
It
less.
doesn't.
Right.
It doesn't decrease with age.
Correct.
All right.
There's no flexibility to it. You can't decrease it. Like 1 month you can't pay the $1,200. Okay, I'm going to pay $300 this month.
Okay.
Unless there's like a rider or something added on to it. But
Okay.
IUL is like automatic, and this is really just to protect your money. It's not. It's not to become rich, right? So some people think they're going to get these things and become super rich. It's not to become rich. You get it, you build it, you move it.
Right.
That's initially what it's for.
All right. Let me bring you into the conversation, Greg. So my little case study here.
That family, in my opinion, should put away $17,500 a year, which means
$17,500 a year. Does that sound
15% of their total income. And if they're going to pay themselves first, they could do it on a weekly or a monthly basis. But at least 15% of the income of that family should be put aside every year. That's my opinion.
Okay.
That's our base case.
okay?
Now, the next thing, what's
So
more
what about a
important?
family? Because now I'm going to become a little adversarial, right? So what about a family that can't put away the 15%? Are they just
They're
lost
living
in the
beyond
sauce?
their means. This is a situation almost like we would say, if you're not 15 minutes early, you're late.
Okay.
If you don't have 15% in the bank, you're living above your means.
Okay.
And that is encouraged. You know, the idea of wealth that I mentioned earlier is like an amount of time you can go without, working or on accumulated resources. That can be negative as well. If you're half of your year's salary in debt, you're 6 months behind. So for 6 months, you're spending other people's money.
Got it. So that includes credit cards
Yes.
and what else?
Credit cards, student loan debt,
Oh, okay. Credit
home
cards.
equity
student
that's
loan-
negative,
Okay.
a car that's brand new.
Okay. Oh,
You
yeah.
walk off
Oh,
the lot with
yeah.
that car, you're 30% in the hole. You just paid, a lease.
And the value goes down once you drive it off the lot. Too.
Yeah.
Those are scary things. And again, it gets into the concept of like assets. But the last thing I would say on the topic of the family is what's most important is how much of that money are they keeping? How much are they deducting on their taxes every year? Because I'd rather earn 150 and pay taxes on 80 than earn 200 and pay taxes on 180, which is 90,000.
Yeah.
Right off the bat. So the tax issue, are they saving in advance for healthcare? Are they saving in advance for their educational goals? Because if they are, those things can be tax deductible in the year they're saved, including their first nest egg for trading, which they can teach their children about. Financial literacy begins with kids. Do they know how to save?
I agree.
Can they
And
put...
I believe it should be in
Yeah.
incorporated in the academic school year.
Oh, forget it. The public school system will fail you immensely in this regard. But the credit card companies will tell you what you should do by the time you're in college. Before you even had a paycheck, you'll have a credit card. So to me, that's a bit of it's an imbalance of power. And it's a conspiracy against working people.
Okay.
That's
You
just
wanna
my
add?
opinion.
Well, yeah. I mean,
Because I'm hearing both perspectives here. I'm hearing
it's amazing
15%.
how-
I'm
yeah.
hearing 2
Yeah.
to 5%.
Well, ideally, I mean, if you can put away 15%, that's really difficult for most people, but it is ideal. I'm saying 5 to 10% because that's the average, and that's typically what I see.
Right.
That's typically what I see.
Okay.
So most people, when you say 15%, they get a little scared.
I was
That-
trying to watch my body language, but that is over $17,000 a year.
For that family.
for
And
that
it could
family.
all be
Okay.
tax deductible. That's the thing. They will pay less taxes on that, which means they may get up to 30% of that back in spending power the same year they deduct those on their taxes, those expenses.
And again, you have to be extremely disciplined to do that.
You have to be realistic, and it has to start pretty much immediately. If you're already in debt, that's a separate issue, and
Okay.
that's something we can talk about too. But when it comes to financial literacy, the first thing is spending less. So you have to know every dollar that's coming in, every dollar that's going out. And that's an issue that most people use an app for nowadays. Not as many people use cash. But I would argue in the same sort of vein, the war against cash, the removal of cash from our eyes and our wallets is part of what's making it more difficult to stay ahead of this wealth game,
Yeah,
which is
I
set.
agree.
It's
I
set
agree.
up. The rules are set in advance.
I agree. And
So-
you have to be. I use the word disciplined. Like for me, I usually call my bank almost maybe 3 or 4 times a week just to make sure that I'm calculating the amount of money that I've spent in my head correctly with what has been taken out of my account for everything that I purchase. I deliberately don't have a lot of when they take the money out of your account to pay your
Auto
bills, I
debit.
do it on my own
Yeah.
because I want to keep a mental calculation of where my money is going. Some people say, I have to catch up with the times, but to me, I think I'm where I should be. I don't know, maybe it's like a bugged out situation I'm going through, but that's what I do in my head. So I call the bank a lot, just to listen to the automated service. Now, as far as this family, I'm gonna bring Corey. Corey, are you on the line?
Yes, I am. Can you hear me okay?
Yes. You may have to speak up just a little bit. I'm so happy that you were able to get through. Was that you trying to call in?
Yeah, it was. Absolutely.
Okay. So I may have to put on my can you turn that up just a little bit so we can hear with our headphones? All right, Corey. So I just want to bring you into the conversation. First of all, I want to say welcome. If you have anything to add based on a little bit of conversation that you heard, we can move forward with that.
Well, I guess from my perspective, we were talking, and I've been hearing some of the conversation, and you've been talking about, of course, about financial literacy and the challenge that people have around money. And, I've had those struggles throughout my life as well. And I have to say that just from an observation perspective, I'm actually surprised. I'm seeing a lot more of it these days with, in terms of the challenges around money, where people that I talked to a year ago that weren't struggling now are really struggling. So I think this is something that, that's very important. And even though it's always been a challenge, it seems like there's kind of a shift that's happening that's making it even more challenging right now. So I guess that's the first observation that I've been noticing recently. Okay.
And in terms of, I gave a little scenario, but what would you say in terms of financial literacy and becoming financially stable? What would you say in regard to a family of a husband and a wife? They have a dog. They're renting at the moment. They have 2 children. One is in college. One is in, I would just say, middle school. The husband earns about $75,000. The wife is earning about $45,000 in terms of saving, possibly ownership moving forward, life insurance, things of that nature.
Well, and so I guess I would have questions first in terms of, what because I may have missed this part if you guys have been talking about this example in terms of what their bills are and what their debt ratio is and stuff like that. So just as a clarification, are you talking with those details as well, or just as a general question?
Well, you can answer it as a general question, and I can also bring you into the loop about what Marlon said in regard to them saving at least anywhere between 2 to 7% a year.
2 to 10%.
2 to 10% a year, and I think Greg said 15% a year, with that based on those 2 salaries.
So I guess my perspective on it is that
it's not just me.
Well, first and foremost, and I don't know if this was discussed, and I apologize if I missed part of this, but I'm a big believer on paying yourself first. And I don't know if you guys have ever heard of the book The Wealthy Barber, but I love in that book he talks about the 10% down rule. So paying yourself 10% first before anything else comes out, and before you jump into bills and entertainment or anything else that you're going to spend money on, if entertainment's even possible. So I guess my first part would be I believe in paying yourself first. And I do feel that those numbers work. I do feel, I said 10% as an average, but I think anywhere from 2% to 15%, whatever they can put away, I think is actually quite realistic. But again, I guess it depends on what their existing debt is and what they're trying to pay down as well.
Okay. All right. So I love the fact that you joined this conversation, Corey, in the right time, I tell you, because you're kind of like in the middle of what Marlon and Greg said. So you're the happy medium. Thank you so much. So without further ado, I want you to introduce yourself. Tell us a little bit about you. We heard a little bit from Greg and from Marlon.
Yeah, so I guess in terms of a perspective of how I spend my time, who I am, my background, all that kind of stuff, this is a super quick summary. I was raised by a single mother. I grew up in a very small community, and at 20 years of age, I moved across the country, and I basically decided that I wanted to work in the corporate world. I spent about 10 years in the corporate world, and mostly a sales capacity, and then somewhere along the way, I made the decision that I wanted to go into the world that most people don't want to be in, which is the world of professional speaking. And I jumped into that world feet first, and I've been speaking for years since then, about 15 years. But when we come around to the idea of financial literacy, What I didn't actually learn or know or understand, even at that point, was about the importance of passive income and the idea of trading time for money. So I was trading time for money in a really big way in the corporate world, and then I switched to speaking, thinking that somehow I was escaping that, only to realize that much the same, if I don't speak, I don't get paid. If I get sick or if I get injured, I don't get paid. And so I kind of went to, basically into business for myself as a speaker, but didn't realize the importance of having an income that could come in even if I wasn't able to get on that stage. And so that's sort of, I guess, a background in terms of, my journey. I mean, that's obviously a very short version, but small community, raised by a single mother, struggled when I was young, jumped into the corporate world, had some success, decided to make the transition into speaking, and enjoyed a decent career as a speaker, but then started to realize after I would be sick or miss a talk that all of a sudden you instantly lose money. And I may have even been paid a deposit that I now have to pay back. And so all of a sudden I started looking at the idea of how can I take my speaking business and also add a passive income to it. So that's a nutshell.
A passive income. I like that statement. Greg, you want to add to what Corey said?
It sounds like a lot of sacrifice, no doubt. Traveling around and having to be responsive to an audience environment. Kudos to you. Welcome aboard.
Where are you stationed right now?
So
Where are you right now, Corey?
Where am I right now?
Yes.
So as I mentioned, I travel a lot, so I'm actually in the far east coast of Canada right now for a talk later this week.
Awesomeness. Okay, we'll talk a little bit about that a little bit later. So let me just bring Marlon and Greg back into the conversation so that they can give some feedback on your current statements.
There's something that comes to mind about our family.
Okay.
First of all, I'm not afraid for them. If 15% of what they earn immediately disappears as if it were never there, what's it going to cost? There'll be some things they lack, but they'll probably end up closer. They'll end up more disciplined, and they'll end up with a more realistic understanding of where they're at. Because debt distorts reality. If you're continuously moving into debt, you're distorting the reality of what your purchasing power allows you.
Right.
And you can misalign your lifestyle. And as a result, that frightens me.
Right.
But, people that start to become a little bit more realistic about what their lifestyle looks like will end up in the long term being happier people. That's my basic theory. Okay. And the Millionaire Next Door talks about that too. Sacrifices made now. And what's interesting, an intergenerational study of American wealth yields that some people are better at this than others. But the truth of the matter is, after about 3 generations, most wealth is gone. Because the generation before and the generation before that failed to recognize the essential reality of this. You have to earn more than you spend, or find other ways to earn, which is what current technology seems to be allowing more and more.
Okay. Marlon?
In strong agreement. I couldn't agree more. So just to add on to that, and just kind of piggyback off of it rather, there are ways to avoid losing that wealth over a generation. Again, I mean, I'm probably going to sound like a broken record here, but life insurance is one of the guaranteed ways you can avoid losing that wealth.
And what type of life insurance?
We're talking about permanent, not just term, because remember, term is more like renting an apartment as opposed to owning a home. Okay. Right? When you rent an apartment, you don't build equity, do you? Right? But when you own a home, you build equity.
Yes.
Right? Now, the downfall to it is if you're living in that home, it's not necessarily an asset if you're spending more money than you're actually keeping while you're living in that home. Meaning, if there's a hole in the roof, the boiler breaks down, all of this happens within a year, and you paid, I don't know, $40,000 on the down payment, and you're still paying a mortgage for about 15 years at 4% interest rate, and you've just forked over maybe about $60,000 for repairs and a whole bunch of other stuff that you don't necessarily need.
That's a downward spiral.
That's a downward spiral, right?
I'm learning.
You have to prepare for that. Now, in this situation, let's use that real estate example, right? In this situation, I would say automatically to a person, okay, you're going to need life insurance. They're going to look at me and say, well, how am I going to need life insurance, right? Why would I need life insurance for this?
And how am I going to pay for it with
exactly,
all this debt?
Exactly. This is called decreasing term life insurance that they would need, basically to match their mortgage, right? So they would get a life insurance policy that's a term policy that would match the exact amount of their mortgage. As the years go by, as they put money into that, it would decrease. The premium payments would decrease. And if something were to happen to them, they can pay off the mortgage with that life insurance. Right. Done, right?
Sound good, Greg?
So far, so good. That's a good service. No doubt.
Now, the permanent life insurance, that's used for an indexed account because it has a savings account attribute attached to it. Now, why would you want to use that? Well, number one, it's tax exempt. It's after tax dollars. Okay, so you're taking some money and you're tossing it in what we as life insurance agents like to call overfunding. Okay, you would take a little bit more money than you have to pay on the premium. Hopefully they're fairly young. We don't know their ages, but hopefully they're fairly young. And if they're not fairly young, they can get term policies on themselves.
So let me add ages. Let's go with, how old are you? Well, Greg, you want to say?
40.
Okay. So let's go with 37 and 45.
Okay, 37 and 45. Now in this
You
situation,
following us, Corey?
Yeah, absolutely.
Okay,
yeah.
go ahead.
So in this situation, and it's funny because I've actually had this situation about several times with clients, right? Almost the
Good.
exact scenario. It's just ridiculous, right? So you have these two people, 37 and 40, well, between 40 45 years old. And obviously they're getting older, so life insurance is going to become pretty expensive. Okay, the older you get, the more expensive it becomes. Now, here's what they can do. Here's where buy term investor difference becomes your best friend. Okay, so you can buy term insurance to cover the death benefit. This is your net worth after death because you're still taxed when you die.
And how would you know how much your net worth is after death?
Well, that would basically depend on the death benefit of the life insurance policy, and also how much debt you leave behind when you pass away, or how
Got
much
it.
debt you're going to leave behind when you pass away, right?
Okay.
And there's also that death tax. When you die, you're going to get taxed anyway, right? So, and then there's the inheritance tax, and just ton of taxes,
taxes.
right? So we're not going to go into all the taxes, but there's a number of them. Okay, so you have that buy term. So you buy term. Now they have two children that are in college. Obviously,
No,
well,
one
one child
child.
is in college, the other one's in middle school, right? So obviously, these two children are pretty young, especially the one in middle school. So here's what you do: you buy term. Now, as long as you have a life insurance policy, you can get whatever you want for your child. Okay, as long as it's within the financial means. So you have the college child. Let's say that child is about 19 years old. You can get a permanent policy on that child. That right there is a legacy you can pass on to them. Okay, 19 years old. Let's say the premium is, if they're in good health, roughly, let's say about 27 to about $40-something, depending on the death benefit that you actually choose.
Okay.
Now, with the cash value attached to that, you can probably toss in a little bit more. Now, the middle school child, a little bit more difficult. Okay, you have to get at least half of what the parents have for the children. So you can do that. So let's say that the parents have about $500,000 apiece, for example. Okay, now the rule of thumb is to use what's called the 10-20 rule. 10 times for proper protection, 20 times for retirement. So the $75,000 a year income would roughly be about $750,000 in life insurance, whether it's term or permanent. Okay, in this situation, we want to get term. That's on the father. On the mother, $45,000. That's $450,000 for a term. Now, if they can't afford the premiums for those, you can chop it down. Right there, they're covered to protect their family if something wants to happen to them.
Okay.
Okay, they're protecting their family, they're protecting their assets, they're protecting, if they have to pay rent for a few years, if one of the parents pass away, they have to pay rent for a few years. If they want to do that, they can do that. They can take the permanent policies on the children and invest in those policies. It's still theirs because they're the owner, right? So they can use that money. It's still a savings account, right? So they can use that money. Now, will you get a higher return than you would in the bank? At this point, yes, you would.
Okay.
So you can definitely use that to your advantage. Now, can you transfer that money to something else that's tax deferred? That's another story for another time, but yes, you can.
So let me bring Corey into this. How are we feeling on the other side in Canada, Corey, about what you've just heard from Marlon?
Well, so I mean, I guess everything sounds perfect to me in the sense that obviously he knows the industry, he's living in it. But I will say it's interesting because
So,
of my
Corey.
age, I'm fairly close
Corey.
to their age. Yeah,
Oh, speak a little bit more directly
Oh,
into
yeah.
the phone.
yeah, absolutely.
Okay.
Can you hear me better now?
No.
Okay, how about now?
Yeah, you should be good now.
Okay.
Okay, go ahead, Corey.
So what? Yeah. So what I was saying is, it's interesting. I'm in this exact situation. I'm 42. My girlfriend's 40, and we just I've had life insurance for a number of years, and I just actually renewed recently. So everything that that is being said sounds accurate, I guess. And I mean, I don't want to jump us ahead in the conversation, but I'm just curious the thoughts on things like critical illness and disability and how important those are as well.
And including you have a son as well, right?
Yeah, 4-month-old.
Okay.
So it just started.
Okay. All right.
Oh, that's a
So we
fun
can add that into the equation as well. So Greg, let's hear from you. How are you feeling about everything that's been said so far?
These are definitely tough situations. I mean, I think one of the things that's relevant to financial literacy is if you look over the last 10 years at what the major income and, the major household expenses have been, most of those things have gone through the roof. Now, the economists will claim that there's no real inflation. The inflation that's measured by the government hasn't gone up more than about 2% a year. But if you look at rent, housing, healthcare, and I'm not sure what the others would be. Recreation is one of those things. Not necessarily because we're taking more vacations, but just because we're paying more for the things that we get.
Right.
And so there's some things going on there in terms of inflation that cause me concern.
And what about the fact that everything around us is going up, like you said, but our salaries are staying the same?
Correct. That's a working class issue in this country for the past 2 decades.
Yeah.
Apparently, with the absence of any organized labor, a lot of public opinion, for example, against pensions will come out and say, well, this is crazy. This pension, it costs a fortune. We can't afford this. And the response in America used to be, well, how can you not afford this? If you don't have a pension and you're old and you're not productive, how is the country going to be able to take care of you? The answer now is that the government would step in there. But we know these pension liabilities are absolutely unfundable. So at some point, they're going to backfire. Pretty scary stuff.
It is. It is. Corey, you want to propose your question one more time?
Yeah, so I guess I was just posing the question from the, insurance perspective, because it's something that I just went through, and I understand, the importance of things like critical illness if something happens to us while we're still here and having to take care of ourselves, or disability if something happens to us. I mentioned that for me as a speaker, if I'm disabled, income stops coming in. So I guess, when we're talking about preparing for having that savings account that is the life insurance, and that prepares us for if something happens to us. But what about if something happens to us while we're young or we're still here? So that couple we're talking about, what happens if something happens to one of them? So I guess what's the thoughts on the importance of having disability and critical illness? And then the other side is that also takes down the income they have coming in. So that's more money they have to find a way to put away at the same time. So I'm just curious from, living in the insurance world, what the perspective is there.
Oh, Corey, that is a fantastic question, and I'm smiling. I'm grinning from ear to ear because that is a very common question that I hear from my clients all the time.
Because now it raises the 10% to we got to do the 15% like Greg said. I guess Greg calculated everything
The
into
costs
that
involved
15%.
The costs involved are astronomical, but my advice would still be to begin accumulating stock in insurance companies. So, for example, if when the whole Obamacare thing came up, and when the initial mention of Obamacare crossed our public paths, if you had invested in some of the major healthcare companies at that time, your money would be worth about 40 to 60% more today.
And we're going to speak a little bit about investments, because there's one that's just out there all over the place, and I'm still not convinced. I'm trying to convince myself, because so many people are trying to be convincing, but
know
it's
where
just
we're
not
going here.
convincing me. That's a lot of convincing, right? And Corey, you'll probably know about this. We're going to talk a little bit about Bitcoin?
Bitcoin.
A little bit later on.
Yeah.
Okay,
Other things.
so about what Corey just asked the question.
Okay, so that is, I will say that is a very easy question. It is a very, very easy question, and that's why I'm so elated that he asked that question, because critical illness, disability insurance, all of that can be added on to a permanent life insurance policy when it necessarily where it can't be added on to other types of investments. Now, again, investing is great. You want to invest. That's another source of income. But remember, you have 3 ways you're going to get taxed. Now, aside from all the other taxes, right? While you're alive, you have 3 ways you're going to get taxed. Tax now, tax later, which is tax deferred, tax never, which is like your life insurance policies, the permanent ones, right? Which is also known as the 7702 tax code. IRAs, municipal bonds, etc.
What
Now,
about
when it comes
CDs? Someone mentioned on the
CD,
Facebook.
that would be more tax now.
Okay.
Okay, that would be more tax now. When you're talking about covering everything: long-term care, critical illness, disability. Now you can add those on as what's called riders onto a permanent life insurance policy, or you can self-fund and become insured and pay for it out of your own pocket, out of your own savings. However, there's another alternative. The savings account in the permanent life insurance policy can be used for all of that if you fund it enough. Now, not everyone can do that, unfortunately. Not everyone can do that, but there are ways that you can. For example, you can make more money, as Greg said, right? Definitely make more money.
So that means you got to get another job.
That or invest. Like he said, if you were to invest in those insurance companies, because think about it. When have you ever heard an insurance company go broke? Never.
Not in this country.
Yeah, not in this country. Definitely not.
There goes the plan.
Right? So you can invest in those type of companies to build your income, because investing in stocks, that's a tax now thing. Okay, you're gonna get taxed on that year, right? So that's your income. You can make that your income or your side income, right? Whether you're getting involved in those, dare I say it, multi-level marketing businesses, whether you're getting involved in selling, like I said, soaps or cakes or vitamins or whatever.
So a
right?
side hustle.
Side hustle.
Services, sure. Services or materials or products. But I think the overwhelming sense you get, though, is that you have to have something that's of value. You know, and if you're trading things of value, including social capital, say an appearance on a show like this, or an opportunity to spend some time with people, that's capital too. You know, you can't underestimate that capital.
Right.
Even though it's not going to hit the balance sheet, it still matters.
Right.
And the perspective I would use for dividend income, for example, if you have $100 worth of McDonald's stock, let's just say $100, which it probably was about 2-3 months ago. It was also 60 about a year and a half ago. But let's just say $100 for ease of conversation. That stock will pay between 2 and 3% dividend. If that stock doubles to 200, it will still pay 2 to 3% dividend. You bought it at 100. It's now 200, and it's paying 2 to 3% dividend. You're getting 6, even though the new buyer is only getting 2 to 3. So when you hold this stuff over time, it pays you more and more.
Nice.
It doesn't happen fast, and it does not happen glamorous.
Right.
But when you get a dividend check in the mail for $12, you really need to look at that dividend check and say, I did
did
nothing
good.
to earn this.
Yeah.
I
did
owned
good.
an asset. It's almost like having an employee.
Yeah.
You send that bond or you send that instrument out to work every day, and it comes back, maybe with a few pennies,
Right.
but at least it comes back with something. And so that's the perspective I have in terms of make more. You can only work so many hours.
Right.
Time with your family is important. But let's take the attitude of what I'll call someone maybe from out of the country who arrives, and I'll give you 2 examples and they'll be quick. One, drives a taxi. You can only do so many hours. He may work 70 hours a week when he first gets here. At some point, he's going to realize that the money isn't owning the medallion, and then he has 2 taxis. The next year, he could have 4. The year after that, 8. The year after that, 16. No one can double the amount of hours they work in a week
Right.
more than once or twice. So that's that perspective. Not easier said because it's a theory. And when it
Yes.
comes to paying real money for things like what I consider Cadillac insurance policies, like total disability insurance, those are expensive. They cost a lot of money. They also give you a whole lot of coverage in the event of something disastrous. But I don't even think that way. That's like the black swan theory. I can't handle it. You know what I mean? So and that's my opinion on insurance. It's a terrible thing to say, but I don't deal with insurance because my liabilities are such that I don't have issues around that. I'm like, if I pass away, everything's paid. If you have debt on a house or a mortgage and children, you absolutely have to. You're required, basically, almost morally, to have insurance. So I'm with you on that. But it's a business and not one I can afford to pay. That's just my opinion.
But you know what? I can respect all 3 perspectives, and I think we needed 3 different perspectives so that we can bring, everyone can see the holistic approach to financial literacy. So I appreciate it, and I'm learning a lot. So Corey, were your questions answered?
Yeah, absolutely. And I guess the other thing, if I can add it in, because like I said, I missed just the first part of the conversation, so I may have missed this discussion because I know you've been talking about making and finding a way to earn more money. And I think that's the challenge too, is that, sometimes we're talking about a situation where the person is maxed out and the idea of them putting even 10% away is challenging. And the only other option they have, well, there's a few options. One, they can maybe eliminate their debt through bankruptcy, which is obviously not an ideal option, or they can try to find a way to earn more income. And one thing I wanted to say about that is, because I know we talked about getting a second job, or maybe being in network marketing or what have you. But I think the other side too, that the real opportunity today is the fact that we can be online and set up with a business in no amount of time. And I mentioned passive income. I just launched a book just in the last month, and I was able to earn a nice passive income in the last month with this book that I put out. And I earned more than I ever would have if I would have went out and worked a job hourly. And yet at the same time, it's an asset. We were talking about assets that I can keep using over the years. And, not everybody's going to write a book, but I just think that now we have this opportunity with the online world to set up a business as long as we have something of value and still not give all of our time away. I still make time for my child, for yoga, for all these things that I have in my life. And I think it's just a matter of leveraging your time. But I think if you want to invest more, one of the opportunities is to actually find a way to bring more into your life. Mm-hmm. And if you're at a job and you're getting taxed at whatever the number is, 30% or whatever that number is, it's hard to find that money to put away unless you can figure out a way to bring more in. So I just think having a side business or a passive income is such an important part of what we can do now, and I think it's easier than ever before. So I'm not sure if that was chatted about earlier on, but I just wanted to kind of throw that into the mix as well.
No, we appreciate that. We appreciate that, definitely. And I just wanted to throw out another scenario so we can pick Greg's brain a little bit and then share a little bit more about the, financial literacy. So let's just say a person has $5,000. That's all they have to invest. Mm-hmm. What would you say would be the best avenue to go about doing that?
I would probably write off $5,000 with a traditional IRA. So right off the bat, whatever your tax bracket is, you're getting that much money back to spend immediately. So like, here's this $5,000, you can't spend it, which is upsetting. I would rather spend $5,000 than put it anywhere, really. I'm not that excited about stocks, but once you don't pay taxes on that money, you basically are getting $1,000 back immediately. And then I would suggest, again, you're asking me, so I have a biased perspective. No rational family head is going to go, trading on Forex commodities, but I would put it in a trading account, and start to begin to have an appreciation for what it's like to choose an investment, to execute the strategy, and then to follow it, so that when something comes up in Target, you go, it's the Target crowd is getting into a fist fight now. And, down south, I think we all saw those films. There was a big fist fight at Target. As a stockholder, you go, oh, no, this is no good. Mm-hmm. You start to think about perspective on businesses.
And there's a difference between being conservative and aggressive and
big time. Yeah.
In regards to stock, right?
There's a long-term conversation for that, which you would have with the financial advisor, because there are different categories of investments. But I think the short term is, it's extremely risky. And the things I talk about are extremely risky, so the payoff can be quite amazing, And to
but
some
over
extent,
time, because we live in a society where instant gratification is on a mission, and people don't want to see that $12 check, or the average person who sees a $12 what will you call it again?
A dividend, yeah.
A $12 dividend is like, what is this? What am I supposed to do with this? But, after assessing, you're like, wow, I actually made progress. This is good stuff here, and like you said, I did nothing to get this $12. So if I kept doing this, could you imagine how much money I would accumulate? But how do we get people to that point where they're actually thinking in those terms? Because you have to change your thinking, which transfers to your behavior.
Absolutely.
And then first it's like a thought about finances, then it's a feeling like you get all excited or discouraged or however the case may be, and then it's like the behavior has to change. So we're talking about brain change, behavioral change, feeling change, all over the place. So how do we get people to do this?
This is why it's such a touchy issue if you think about it. When you start to talk about money, and we're in downtown Manhattan right now, so
yes.
There are billions in electronic money firing across these sidewalks all day long. Mm-hmm. And I think for people that are masters of that universe, it's not even about money anymore. It's about keeping score. It's about points. It's about doing whatever is necessary in terms of being able to marshal resources, because your money is basically work that you saved. It's work that you put aside for some other time. That's what money is. That's what currency is. That's what cash is. It's basically, in a way, it's a stored form of time. But over time, we find other things to sell that are maybe more valuable than our time. Experience, maybe a lecture online that can be duplicated thousands and thousands of times. investments we make in education, whether they pay off or not. We can talk about education as an investment, and it's likely to get controversial because I think that's the worst long-term investment ever. My parents didn't send me to Princeton, they didn't send me to Yale. Okay, I didn't finish college. But in 1995, growing up in Brooklyn, if my parents had said, you know what, we're going to send you to Fordham, let's say. Not a great school, good school. If anybody here's from Fordham, I'm not knocking it. But I'm just saying, not Ivy League. Would have been about $175,000 to send me to that school. They could have put a down payment on a brownstone in Fort Greene in 1995 for $175,000, and now I would be a millionaire.
That's right.
And I would own property, and I would have learned how to deal with tenants, how to deal with taxes, how to deal with permits.
So are you saying, as a segue, maybe college is not necessary for financial literacy?
It's a very tricky issue, and I hate to get into something as controversial as saying college is not a good idea.
Well,
But
college is not for everybody. We've defined that on previous shows, but in terms of financial literacy, you're allowed to be biased. We need to know.
the return on investment for a college education in this country has worsened considerably. So
Even though 4-year college is free for some?
Oh, that's a great deal. If you're getting something for free, that's a completely different issue.
Okay.
But I think in the overall sense, the jobs that people are being prepared for by traditional higher education simply don't exist.
Okay.
So that's a jobs issue, Whereas if you want to be a plumber or a carpenter or an electrician, and that's an interesting topic because you feel like you're steering people away from an intellectual path. But the truth is, it's a practical way to make money and earn a living. And I think that's more what we're talking about here.
Absolutely.
As opposed to having a sheepskin, and having letters after your name, which is impressive.
Absolutely.
But again, I'd rather make 60 and spend 50 than make 90 and spend 120 trying to keep that lifestyle right there where it needs to be.
Yep.
That's the
Absolutely.
challenge, yeah.
Corey, you want to add to the conversation?
Well, yeah, I mean, I'm in complete agreement. I went the college route, and I finished one of the colleges I went to, just more of a 2-year program. I didn't at another one I went to, and I would agree completely that in terms of, from an investment point of view, it was probably one of the, it wasn't, I'll just say it wasn't the best investment I ever made going to college, and I paid for it through student loans. I didn't have anybody to help me whatsoever, and I'm glad that I left when I did, because I ended up learning more about finances outside of college and sort of by going down the path I did than what I ever learned at college. So for me personally, I'm not saying it's a bad thing to go to college, as mentioned. I'm not saying it's not for everybody, or it's not for certain people. But for me, certainly, it wasn't the best investment that I made. And if I had my time back, I certainly would have made different decisions. But I did definitely travel down that path, and I had that experience. And I think the experiences we had at the end of the day, they shape who we are. But yeah, it certainly wasn't a great investment for me. So I think it's important that people actually figure out if it's for them, if it's going to have the right return, and or if it's not for them. If it's not for them, then I think they need to find out what is for them. Like it was mentioned, like having the investment on that brownstone would obviously be a better move for some people. So I guess I'm saying I'm in agreement with it, that for me it wasn't a great investment, and for some people it won't be. And then there's some people that, like you said, if they're getting it for free, then hey, jump all in.
And there'll be expenses associated with it. Even if your tuition is free, you need housing, you need moral support, you might need a vehicle. Are you going to work weekends, or are you going to have some sort of stipend from your parents to keep you from having to work? Because I worked full-time in college, and truthfully, it became far more important than the college goal, because I was making cash waiting tables at weddings.
Right.
That's the kind of work that young people can get very easily seduced by, because they're walking out of there with a pocket full of cash.
Right. And it's something that's tangible versus something that you have to wait for. Again, we go back to the instant gratification. And I can speak from my own personal experience. I've been, I do have a master's degree in social work. I do plan on going for my PhD. And again, the letters look nice. But aside from that, I'm actually reaping the benefits and embracing everything that comes along with my college experience, and I'm utilizing it within the systems that I work with right now. As Marlon said earlier, which I appreciate and I respect, I embrace the fact that I'm actually a workaholic, a little something, and I work extremely hard to provide for myself and my family. And I think in the long run, and even not even that I think, I'm speaking it into existence, that it's going to work off is going to pay off in the long run, and it's paying off now because a lot of every 2 years I see myself progressing financially, which I think is a good thing. I'm teaching my daughter and my son, and my two daughters. I have a daughter that's in college. When she's finished with college, she'll have a very low amount of debt because I'm putting a little bit of responsibility on her for her to have to pay some things back when she graduates. But for the most part, I'm paying for her to go to college, and the amount that I'm paying every single year, it's a lot, but I think it's worth it. And she's graduating with not so much debt as I did, so I'm paying off my student loans, and I'm also paying for her to attend college, which I think is significant. As far as home ownership, I do own a home. I'm learning more about it. At this juncture, I'm not really using it as an asset. Well, we're not using it as an asset right now, but moving forward, we probably want to purchase more property. I'm not really into renting anymore. I would like to own, and I think I have to build first before I can, we have to build first before we can decide to purchase something else. And that whole system in purchasing is oh Lord, it's a lot.
Yeah.
But it was, for what it was worth, it was a long process, but I can respect that process now that I'm not in it anymore.
Everybody gets paid during that process too. If you look at how important home purchases and home sales are to the economy, I mean, you're talking about title deeds, things are being written
so
down
much.
by people that's cost thousands. There's interest rates, points, there's filing fees. Some of these things don't even mean anything. That's another discussion altogether. But congratulations on having the joy of home ownership.
Yeah, thank you. And then, and moving forward, Todd and I have a whole bunch of endeavors that we want to get into, and possibly owning a building at some point, but again, you have to stack first, so I'm learning more about that. And I have to say, again, from a personal perspective, working all these different side jobs, teaching and running groups and facilitating classes and things like that brought on additional income for us that I was able to stack on and contribute to, the down payment for our home. So, and I continue to do that so that we can get something else a little later on.
Yeah, it is a different perspective to your stakeholder. If you decide to take a wall out, or if you want to change a window or whatever, when you're a homeowner, it does change your perspective and your appreciation of the neighborhood and the place that you now are. You're an investor in that area.
Absolutely.
So it changes a lot of things in terms of perspective, I think. No doubt.
Marlon?
Wow. I'm kind of jumping at the bits here, but as I listen to the conversation, I can talk about, number one, the college issue from two different perspectives. One, as being someone who went to college, and I will agree, it was not the best investment for my money. I mean, I'm probably right there with Corey, as in, I learned more about finances outside of college than I did when I was in it.
I agree with that.
So I absolutely learned nothing, and I went to college for business. I learned absolutely nothing about money, how to build money, how to work it, I didn't learn anything. And I didn't learn this one simple rule, which I know you love. We've talked about this before. I didn't learn this one simple mathematical equation, which is the rule of 72, the rule of compounding interest, which is what we've been talking about since this thing started, right? So I got to throw it out there and just kind of educate the people out there a little bit for those who haven't heard of it before. Now, the rule of 72 was just kind of brought into light by Albert Einstein. Everybody who's into financing and stock knows about this rule, right? All it says is you take the number 72 divided by whatever interest rate you're getting, receiving, or having to pay back, and it'll give you the amount of years it takes for your money to double in terms of growth or repayment. Now, we can look at that for credit cards and say, oh my God, I'm about to go into some serious debt. Right, 72 divided by 24% interest rate is not good. That basically means that you're going to have to pay back double the amount that you actually took out in 3 years or so. But let's say you had an account that was about 7%, 3%, 4%, 9%, looking pretty good, right? 18 years, your money will double. Take $10,000, and this is where also when you look at stocks, you look at real estate investment, you look at life insurance, this is where this all comes into play. Everything revolves in finance and even in life, everything revolves around the rule of compounding interest, right? Even building a business, right? Which is why I also mentioned network marketing earlier.
And it's true with building your business, you spend more initially than, within what, 3 to 5 years?
3 to 5 years, yeah.
Okay, because when I went to the startup for businesses. It was a program at the New York State Library downtown. They were saying that when you're starting a business, you shouldn't have to put any money in at all. I didn't know if that was a fact or a myth.
Well,
Not
you
if
don't
it's a
necessarily
newspaper.
have to. I mean, it's kind of it's pretty much a myth. And now I'm sorry.
Why do you?
No, no,
Okay, tell me why, Marlon.
Well, it depends on what business you're getting into. First of all,
Okay.
Obviously, if you're doing something that's creative, that's coming off the top of your head, you can start a business without getting an LLC and just kind of put up a name and start your business and get it going.
So it's
earn
doing
capital.
business as.
Right.
Okay.
Okay, so you could just start building up capital and just taking funds in, taking cash, taking credit cards if you can. I mean, there's certain programs out there like PayPal and other sorts of programs that you can use where you can receive this cash directly to your account or whatever have you, right? Then there's other businesses where you would have to directly invest in, such as trading, such as being an insurance agent or broker, opening a firm, being a speaker, because you have to take certain classes, right? Like Corey does. You have to take certain classes. You have to get certified in certain things in order to do this, in order to be recognized as, whatever it is that you're doing. So it depends on what you want to do.
Okay.
Right. So, I mean, I've seen one of the things I also do, as well as being an insurance broker, is business development and leadership development. And I help people develop not whatever business they want, but I give them a better insight and help them put in place systems for their business.
And do you determine or do you inform them if it's realistic or not?
Absolutely.
Okay.
Absolutely. One of the things that people tend to think when they're building a business is that they're going to make money the very first year. Almost no business makes money the very first year.
Absolutely not. And I mean, when I went to these classes at the New York State Library and they were talking, I'm saying to myself, yeah, this is really going to work. And then I was sadly mistaken when I actually got into it, because when I was going out, because I also teach in Staten Island, so I have to drive there. So there's tolls, there's gas, there's all food that you have to pay for, supplies and things like that. And then I had to pay for the classes. So all that money I never paid myself back for, but all the money that I was making from these classes, instead of taking and paying myself back, I would actually just put it into a business account. So I showed the bank that I have that I'm worthy, that I can take this money and I can save on a consistent basis, which got me a grade A with the bank that I'm with now. So, I mean, it worked out for that. But then, when Todd and I want to go out and stuff like that, sometimes he has to not sometimes, he always has to pay because I'm taking.
Hey, listen, that's fine. It's a beautiful.
I'm like, this is an investment. Thank you. It's in the business account, baby.
It's a beautiful thing when you have a significant other, a spouse that is around you, that when you're building a business, they have that extra income.
Right.
It's much harder. It's much more difficult when you're single and building a business.
Yeah, that's why I always refer to Todd as my number one supporter, because he truly is my number one supporter, and holistically. Yeah,
Helps
absolutely,
to have a partner, no
absolutely.
doubt.
So Corey, I want to bring you into the conversation. How are you feeling about everything that's been said so far?
Well, yeah, absolutely. In terms of, I guess what I'd like to, jump onto right away is what you mentioned about the idea of whether or not you need to invest any money, or you should invest your money into starting a business. And my belief is it depends. So as mentioned, I certainly invest in professional development. That, as a speaker, that's where my biggest investment is. So investing in whether it's going to another seminar, learning from another speaker, buying programs, getting certified in something. But I can say that if you're setting up as a consultant, depending on what you're consulting on, or if you could even be just setting up to sell on, let's say, Amazon, where you're doing relabeled products, where you're taking a product that's already out there and you're selling it before you even necessarily buy it. If you set up with a supplier that way, it is actually possible to set up without investing in your business, more so now than ever before. But I would agree as well that there is always some investment. And then let's not ignore our investment of time, because it's the one asset, it's probably our most valuable asset when we can't get it back. So you're either putting in sweat equity if you're not putting in some money, or you're putting in money. So I guess I would say that I think you do have to invest in some way, shape, or form, but you can certainly minimize that investment today more than ever before. And I think that's kind of exciting for people who are maybe just, barely making it and then see having a business as another option. And I guess it was also mentioned, and I can't remember because I only heard it once who mentioned it, but about network marketing. That's for some people, not for others. But what I will say, and you can correct me if I'm wrong, but the investment is very, very minimal. I mean, when people set up in network marketing, I think a lot of times they can set up for a couple $100s. So you can actually set up with a business in a lot of different ways for a very minimal investment, which may not have been as possible before when it was almost all brick and mortar. So I think there's a really cool opportunity now on the financial side to learn a lot about money and at the same time not invest a whole lot of your own if you're willing to put in the time rather than the money. So that would be my take on, in terms of investing when it comes to a business, and in terms of, like I said, learning a bit about the financial side of running a business. You can actually learn a lot of that in the trenches without having to invest the kind of money or even lose the kind of money you would have had to invest in a bricks and mortar business maybe 30 years ago.
Greg?
The Brooklyn perspective on this is if you want to start a business.
Say that one more time. The Brooklyn
The
perspective.
Brooklyn perspective on this, is definitely, if you want to start a business, get a corporation. That's it. Incorporate.
LLC.
Once you incorporate, you are a business. I mean, and again, I reference Brooklyn only because there's a bravado there that people, they know what they are. They're a product. They're already a product. They've become this thing as a result of their upbringing. I know a lot of people who started their businesses by incorporating, and all that means is that, like you said, there's limited liability. You cannot be sued if an action is taking place. You could even do this for a block party, or you could do it for a local dog grooming fundraiser. You can incorporate pretty much anything. But once you do, I think it changes your perspective, because now you do have something to protect.
Right.
People who are in debt, I have nothing against debt. What's interesting about you mentioning the administration, this is a bankruptcy master. This guy's net worth, you cannot question it, is he's got a lot of voluntarily entered into transactions that led to a great deal of money. We can say that. But he also declared bankruptcy. So bankruptcy protection is a legitimate way forward. When people incorporate, they're becoming a business entity, and so they can act differently with their money than they would on a personal level.
Right.
For example,
It's separate.
I have a life savings. I don't trade it on commodities. I don't have my life savings in a stock, because that would be crazy.
Right.
And yet I love to trade stocks. I think that's one of the best ways to rapidly increase wealth if you know what you're doing. I don't consider it gambling. But I hope that ties in. But I would definitely say, to start a business, incorporate. And if you're going to do a business successfully, you have to be passionate about what that business is about. Even if it's welding, people get into that. But if you don't love your business, if you're getting into it to make money, you're very likely to fail.
That's right.
Because you won't be able to compete with someone who's genuinely drawn to that business, even if it is driving a cab. I have a friend of mine who started a music business, got involved in a 10-year lease on a commercial space in Red Hook, sold the lease, liquidated the business because he made more money on the 10-year lease that he had acquired than he would make running his business. So open yourself up to opportunities like that. People do trip over fortune. It happens because the nature of business is, and I don't know you well enough, but I suspect you show up. When you show up to things and you mean business, people, you're going to see opportunities come out, especially with the city. We live in a city that people would kill to have the opportunities that are falling off the crumbs of City Hall in this place. They would travel, thousands of miles just to be in a city that allows people, to, if you have a small business, actually get some support from the government, which is a rarity.
So when we speak about business ownership and becoming a corporation, that I understand that the corporation is separate and apart from you. So for example, when you are starting a corporation, of course it has to go through the state of New York.
Yeah.
And also you're no longer doing business as, but you are the business. Okay.
You can form a board of directors, and then there would be more liability in terms of other people.
Okay. And if you were to be sued, you personally would not be sued, but your business would be sued?
Correct.
Okay. And the other thing is, when you're applying for an EIN number, what if the business is under, let's just say, for example, I'll say John Doe or Jane Doe, and then the business underneath? Or should it be the business first and then John Doe? Or does it matter? Because that tax identification number is more or less linked to your name versus the business.
It should be really under the business rather than your name. You want to, the idea is to separate yourself from the business entity. Now, if you are the business, let's say, for example, if I was to put my name out there as Marlon Phillips LLC, right? There's a
it.
reason for that. That basically is my brand. So now I'm making myself my brand. But if I go the other business route and give another business name, it's still almost the same as a DBA, right? Or an OBA, outside business activity. Okay, because I can make myself my brand, my name, my business, and turn around and have another business, and it could both be the same thing.
Okay.
But then one, I'm doing business probably, let's say, as a trainer or a coach or a mentor, whatever the case is, and then on the other side, I'm doing actual transactions, right? So you can do it either way. Now, you're gonna probably have to pay twice if you do it that way, but you can do it, right? And that brings us, I guess that also ties into what I wanted to talk about as well, which is incorporating your family, right? So you have your LLCs, you have your incorporations, your S Corp, C Corps, right? LLC probably is one of the best ways to go because if you don't have a lot of capital to start off with, you definitely don't want to go the route of an S Corp or a C Corp because, there's extra taxes that are included with that.
Absolutely.
Until you build your business to the point where you can actually afford it, then I wouldn't do it, and you have a few employees that you can, write off or whatever. You definitely wouldn't want to go that route. But you can build your family as a business. And this goes into what we call the LP, limited partnership, or LLP, limited liability partnership. You would turn your family into an FLP, family limited partnership, right? Basically meaning that every officer that's going to come into your business is a family member, right? So if it's you and a spouse and you have 2 adult children, that's your board of directors right there.
That's your FLP.
That's your FLP. Okay, so that's what we want to really do when we talk about building a family legacy.
So let me because Todd and I are working on that. So let's just say altogether there's 6. There's Todd and I, and there's 6 children, and the board is. I guess I'm the head of the board, and then there's 7. So there's Todd, and then there's the 6 children. But it wouldn't. At this time, Building Safe and Communities doesn't fall under FLP, but it falls under LLC. But they are my board.
Okay. You can change it later.
Okay.
You can, in fact, I won't even say later. You can pretty much change it almost any time. You just have to file it with the state as an LP.
Okay.
Right. One of the things that you can do, and you would look at it this way, is write it out. Map it out, just like you would your goals, just like you would your financial situation. Just kind of map it out. Who's going to do what, and appoint people to different jobs. Now, the children, of course, have to be of working age. We know that's about 14, 16 years old, right? Obviously, they can't really be on the board, but they can be employees.
Right.
Right. Now, you would have to give them a little something.
That was the other question I wanted to ask.
Right.
Instead of, because someone else was on the show and they were talking about the board, they are their board. Meaning, so I'm Building Safer Communities. It's just me on the board, but I can add under me whoever I want to add. So let's just say 7 additional people. But I don't necessarily have to say initially that they're a part of the board, but they are a part of the board. Does that make sense?
Yeah, you can.
Okay.
You can definitely do that.
Okay.
The younger children under 18 initially would probably act more as heirs. Right. In the insurance terminology, we call that beneficiaries.
Okay.
Right. All businesses, and I've come across many different businesses and helped them with this too. All businesses should have some type of insurance policy on their business. You have what's called buy-sell agreements. Right. Now, let's say, for example, right, you have a married couple and they decide to split, and they have this FLP, this business going on. Right. Well, what's going to happen? Neither one may not like each other, right? They may not. Who knows, right? So they may not want to do business with each other anymore,
Right.
right? So how are you going to buy each other out? Who has the money to buy that person's shares? Well, that's where insurance comes in, and ideally, it's life insurance. It's called a buy-sell agreement.
Right.
Or what if one of the children happens to be the main producer? Right? You can no longer produce. That child is of age where they're going out there, they're selling, they're trading, they're speaking, they're whatever it is. They're doing everything. That's called key person insurance. That's also life insurance. You now have insurance in that person's life. If something happens to them, you can actually pay someone's salary from that
Right.
insurance policy to take care of the person that's coming in to replace them,
Good stuff.
right?
So corporations, like insurance, can be pretty much crafted to fit almost any purpose. It's kind of shocking in a way. And like for me, the only thing I'll say in terms of financial literacy, one, don't get divorced. Two, don't gamble. You know, these are two things that are flat out rules, but also like, you know, some of what you're talking about in terms of product specification. You know, as your needs change, all this stuff can change. And you get talented people to surround you, accountants, lawyers, you know, people
Right.
that do this for a living. I mean, imagine paying your family member a salary. You know, is that tax deductible? How does that work? You know, when contributions are coming in and going out a different way, you know, there's bookkeeping, there's accounting. All of these things can be done to benefit you.
Right. And it can be go in the system as administrative fees.
And it's a skill set. I mean, ultimately, if you're able to report on this effectively and you're able to organize this stuff and you're able to tell young people that this matters, like it's not just about what we're doing, it's about the accounting, it's about compliance, it's about, you know, keeping things legit. Those are all skills that somebody would be willing to pay for. And ultimately, that's what we're talking about here. Having
That's
skills
right.
that people are willing to pay for. Having a
That's right.
service or some opportunity that people are willing to sacrifice some of their stored time, you know, and maybe give it to you, you know.
That's right.
And the insurance thing gets complicated. There's no question about it.
We haven't got him yet. He's
He's an
turning
example of a
red.
professional. Right? He's just getting warmed up.
Corey, you want to add to the conversation?
Yeah.
Well, I guess so. I guess first of all, I would completely agree about the importance of incorporating. But what I will say is this one area I don't have as much experience on because I just believe in the importance of it and did it myself. But I, of course, I hired somebody to help us out with it, and it's definitely not my forte. I'll just say it that way. But I agree with the importance on it, and yeah, I think it's one of those things that if you know you'd be well. I'll say that if you can help it, then it's one of those things you should run and not walk to making sure that you are incorporated and protected and separate from the entity. So I guess I would just add in that I agree completely.
Okay. All right. So let me ask a personal question. So under the business, I could just hire all my family members and I'm safe.
No.
Yeah. You want to have a happy life too, right?
Because I'm over here pondering.
These are different fights that you have. Employees, family. That could get tricky.
But in the perfect world, I could just, you know.
People you trust. I mean, yeah, absolutely. That's the basis of partnership. And I think the speed of trust is something that people fail to recognize when it comes to small businesses and when it comes to, you know, some of the things we're talking about here, like a divorce. You know, like this idea of trust and like. I would ask Marlon too, the idea of being a fiduciary, you know, who is acting in your financial best interest? That's a critical component. What I found in terms of assets, if you have them, no problem. They can be hidden. Assets can be hidden. Assets can be used. Like, for example, if you win the lotto, don't take the lump sum. You know, take the payments because 2-3 years in, you're going to figure out how to hide all of that. This is what rich people do in this country, you know? I mean,
Thank you for that tip.
Yeah, they would rather buy treasury bills, which is government debt. In other words, use their money to buy the government's debt than pay the government's bills. I mean, that's really, you know,
That makes a lot of sense.
one is savings and one is you're basically trusting the government to invest your money better than you can.
Is that the balance in the scales?
You know, it's only the beginning when you start to talk about the intersection of politics and money. You know, like money is it's literally killing our people, our regular people in this country. You know, it's breaking them down on a day-to-day basis because the currency we trade in essentially, and we're gonna have to breach into this topic of Bitcoin. The currency we trade is essentially becoming less and less valuable. So if you don't have your assets denominated in something else, in other words, if you're not a 1%er or someone who considers themselves wealthy, you're not benefiting from any of the major changes that have occurred over the last 10, 15, 20 years.
Right.
What they'll call a bull market. That's not happening on Main Street.
Right.
That's Wall Street's money. You know, and it's a collaboration between the banks getting free money, the assets being absolutely blown skyrocket high because money is essentially free.
Right.
And who do you really think is going to be left, you know, holding the bag? We've been here before, you know. I hate to say it doesn't end differently this time, you know. So, and I say that only because when you were talking about investing in commercial real estate, wait for the reset. You know, when you're talking about building a real business that matters, some of the best businesses in our country's history have started in the Depression, have started in economic dire times.
I said, you know, when it was time for Todd and I to purchase the home, you know, we both were very determined, very adamant, very, you know, we were driven. And there was just something about that time. And I said, it is time. it's time now. We need to do this now. Now is the time. And, you know, that's when the market was down, but it was good for us. And you know, you have that feeling and you say, you know, it's time to move on this. And if you don't move on it, sometimes you lose the opportunity, you know. So, and it's challenging, but you should get in where it's necessary.
A partner of mine, when I made my first real estate transaction, told me, literally the quote was that this is not fungible. Money in the bank and a house are not fungible. So that's an important concept, because they cannot, even though they might be worth the same amount of money, they cannot be the same thing. When you buy a house, it's not fungible with any sort of asset, because you're going to live your life there. You're going to build things there, memories. You know, these things are totally outside the perspective of anything financial. But I would advise, before you get into that situation, to consider your debt to equity. Also consider your FICO score, which is a private company, Fair Isaacs and Company. They've been running in this country for about 100 years. They're a little cabal of information keepers that basically determine whether you're worth a risk to a bank.
Right.
That's also a publicly traded company, which you would have done well owning over the last 10 years, but that's another story. So I met with a mortgage broker once, and she very simply said to me, if you know what a FICO score is, I'm not going to make any money on you. So if you think about it, like,
I learned a lot about that.
they want you to know less. It's almost like diamonds. You know, by the time they explain everything, you know, you have no money left. That's my experience with diamonds and mortgage brokers. You know, so you know, it's a buyer beware situation. But the literacy is not. It's not something like, my opinion. Bozo would get it. Einstein would miss it. Some of this stuff.
Right.
You know?
But I also believe that you have to be stable. You know, I think you mentioned earlier, Greg, and you also, Marlon, and I know Corey was touching on this, that family is important. So you make a foundation for your family, and then the assets come later on the outside a little bit, you know. So that home that you're building, it was time for Todd and I to build that home, and now it's time for us to build financially so that we can have more assets, you know, and just bring them together.
Yeah, and that could be an appreciating asset, in which case you'll have equity. For example, you buy a home for, say, $200,000, it appreciates by 20%, so that's a $40,000 appreciation. You own that $40,000 of appreciation.
And also, if you when you're paying your mortgage, if you pay more, like add $50 to $100 onto your mortgage every single month, by the year it drops it down $5,000, $10,000 a year or something like that. Is that true?
Yeah, that is true to a certain extent. One thing you also have to remember, and I learned this from one of my partners, who happened to be a co-founder in this company, Fortitude SES, which is a real estate company over in the Bronx, and his name is Wayne Cook. Been a real estate agent for, man, this guy's almost 20 years. Very awesome brother. But one of the things that I learned about real estate is that, number one, when you're living in a home, as we stated before, the equity does build up, but the depreciation value is always there because of the fact that, number one, you're living in it, you're using it. Right. But the good news is that you can actually use that home that you're living in as collateral to get something else, right? Preferably renter apartment buildings, or whatever the case is. Get into the apartment renting deals, or, you know, renting multifamily units, right? That's where your income is going to come from.
Right.
So, but the one thing you do also want to do as well is get your family involved in the decision. No matter how young the children, well, unless they're like 4 years old or something, right? Get them involved in the decision, because if you're going to build a business, you have to get your family involved in the business.
Right.
You know, you and your husband must sit them down and say, hey, listen, we're thinking about doing X, Y, and Z with the home. What do you guys think? Right. Obviously, they're children. They don't know a lot about finance, but something they say may spark your interest.
Right.
Something they say may be prevalent to what you're about to do.
Right.
So you definitely want to get their input on it. When you look at your equity, you also want to add. You also want to think about the rule of 72, as we talked about earlier, that compounding interest. Right. One of the things I always tell my clients who own homes is don't refinance. When you deal with a mortgage broker, the first thing they'll tell you is you got to refinance. But think about that rule of 72. What are you refinancing? What interest rate are you refinancing at? If you got 4%, more than likely you're going to refinance at 4.5.
Yeah, it's going up.
Yeah, and
Right?
your closing costs, those are not refundable. They're tax deductible.
And when you say bring in your family, you know, when I was trying to incorporate my logo, thinking about what to do, my son actually drew the buildings and things of that nature to help me with my logo. And the little circle here, half circle, is like going around the world.
Beautiful.
So he actually helped me with it. He had windows and, you know, a little bit more, I would say graffiti, but I kind of put it, you know, made it a little bit more conservative to match both of our perspectives. So I think that's very important. I don't even know if he realizes that he's a part of this logo.
Well, hey, you know what? Let him know, because that could also be a branch of your business.
Absolutely.
You know, the marketing and design branch, probably. I'm just throwing it out there, but
Don't listen. It's going. But I want to make sure before we leave here today, we talk a little bit. Corey, you still there with us, right?
Yeah, absolutely.
All right. We talk a little bit about Bitcoin.
Bitcoin.
I say Bitcoin sometimes. I say Bitcoin.
Bitcoin.
There's others too. Ethereum, right? Ethereum is another one. Do you know the other ones?
I
There's
don't
one
know
called
any.
Zinc.
Yeah, I usually don't follow those, because to me, I see.
Oh wait, I'm sorry to
Seeing
cut
those
you
fads a
off.
little bit.
Danielle, thank you so much for tuning in. What's the rule of 72? She must have didn't get all the information. Should just say that really quick. The rule of 72.
Okay, so the rule of 72, the other name for the rule of 72 is the rule of compounding interest. It's 72 divided by the interest rate. And the total of that will give you the number of years it takes for your money to double in terms of growth, like an investment, or repayment, like credit card debt. Okay, so that's initially what the rule of 72 is.
Okay, thank you so much. So Corey, join us. Bitcoin.
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 What's going on in Canada? Are the Canadians trading Bitcoin or what? What's
How
about
are
the
we
maple
looking?
syrup?
And I'm not making a mockery of it, but I'm just, what is it, over $11,000 now?
Yeah.
Oh, okay. So if I put $50 into this, what I get? What 70? Now it's up to $72, or how does this work in here?
Let the trader take this one.
You
Come
know,
on,
it's-
Greg. Look at Greg.
here's-
When he start doing this with his
I know,
fingers,
I don't even know where to begin.
I'm learning. Wait, he's turning red.
There's something called blockchain technology. So
Okay.
that's really the essence of this thing. If you look at a currency, I hope you can help me with this, Marlon. It has to have certain characteristics in order to be a currency. It has to be liquid, which means it always trades. It has to have an understandable value. It has to be able to be cut into small denominations, like pennies and quarters. You know, Bitcoin has established, to some extent, based on the blockchain technology, the ability to replicate the mechanisms of a currency.
Replicate.
It's becoming money. It's
So-
becoming money before our eyes. And the funny thing about a bubble is most of the bubbles that happened in history happened around things that completely changed our lives, like railroads or the internet or
So we should jump on this like we should have jumped on Obamacare.
absolutely not. No, stay away from this thing.
Okay, wait a
Don't
minute.
go near. I wouldn't buy this with your money, right?
100,000% agree.
Thank you so much. Thank you. And he's turning red.
Yes. Don't
So
do
we
it.
know he's
Don't
serious.
do it.
So Corey, how are you feeling about Bitcoin?
This is multi-level marketing. I really do believe that. I mean, we have a perspective for this. You know, it's a network, and the network exists, and it's real. Someone told me one time about Tinder. Okay, I don't know if anybody knows what Tinder is. It's an online
I've
dating
heard
website.
about it.
Tinder. Oh, Tinder this, Tinder that.
Oh,
it's like
boy.
Tinder is people. Okay, Bitcoin is the financial pulse of the world. People are petrified, and so they are flooding money into a vehicle that should be a joke, but has in fact become one of the most stable, long-term preservers of wealth in a country like maybe Zimbabwe.
If I don't put $50 in this and get my money turnover later on, and it comes up that this is a good thing, I'm coming for you.
You should.
No.
Yeah, listen, I had the opportunity to buy a physical Bitcoin. So someone was going to meet me in Park Slope to buy a physical Bitcoin for $600. The next time I looked at that commodity, it was $1,000. That was January of this year. It's now worth $11,000.
Right.
But this is like the brownstone in Brooklyn. Remember that brownstone I was talking about?
Yeah.
If you stayed in that brownstone for 20 years, you know, you met Spike Lee, you saw Brooklyn Tech across the street, you got to know the people in the neighborhood, and God forbid one day you got out and got into a fight with someone and got shot. God forbid. There was a lot of crime in that neighborhood. Think about it. You know, perspective. If you put $600 in Bitcoin and you now had $11,000, would you be able to sleep at night? Because that might be worth $4 in a week, or $2, or absolutely nothing. People rob this thing because it's a little bit harder to control. There are certain wallets that are developing that are becoming capable of storing it without the risk of encrypted data being hacked. But basically, a lot of people have been robbed because of Bitcoin. And I would advise you to look at the companies that trade it, such as Hive, which is a blockchain technology company that trades, you know, publicly, and some of the derivative technologies that are going to come from blockchain, such as when you buy your house and record titles. Title recording could be completely replaced by blockchain technology. Some of the oil and gas applications of blockchain technology are fascinating. Bitcoin itself, I would stay away from. It's a symptom of a sick market. That's my opinion.
Wow.
Yeah.
Well, thank you for that perspective. Corey, do you have any feedback?
Well, I'll just add that I haven't jumped on the Bitcoin train, and I don't intend to either. And on the Canadian side, I think it's worth like 15,000 right now.
Wow,
But yeah, I'm the same thing. I'm not sold, and I'm definitely staying away from it. I'm going to wait out this one and see what happens. But I do agree as well that there's certainly a lot of fear baked into it, and you know, the media is definitely pushing that. Oh, you're missing out, or you have missed out. And in fact, I just saw an episode of The Big Bang Theory, where just the last episode actually, where they talked about how they mined Bitcoin years ago, and now how much money would it have been worth, but they erased the USB that it was on. But anyway, it was actually big enough that now it's on an episode of The Big Bang. So there's definitely a lot of hype around it, but I also agree that I'm just staying away.
Right. They did categorize it on Channel 1 as the big boom later on. And I just want to say to Sean Mason. So Sean Mason was on Facebook. He was saying, so is he said Bitcoin. Is Bitcoin good or bad? So from the perspective of what Greg is saying, it's not such a good idea.
There are better investments. And I would say on the topic of investments to go to a website called Motley Fool, which is an incredibly detailed and sort of authoritative guideline to some of the terms involved in investing. Investing is good. Bitcoin is not the best way to invest right now, only because it's become hyperextended and it's a specialized thing, and there's no protection in terms of the SEC or any regulators that look at this thing to make sure it's legit. So it's very high risk. If you like that, go to the dog track. You know, I just don't think that I don't think you should go near that stuff as an amateur investor.
Don't you just love him? Marlon, what do you say about all of this?
I'm in 100,000, 10,000 some odd %, if that's even a number, in agreement with Greg and Corey. The first thing when I heard Bitcoin came out, I said to the people that I was, people who asked me this question, they said, "What do you think about Bitcoin?" I said, "You ever heard about?" I asked them this question. I said, "Have you ever heard of the one world currency?" Right now, for all of our religious people out there, right? Everybody knows that prophecy about the one world currency, but it's a reality. And basically, what it's talking about is a fad, right? You dump all your money into this thing, as Greg was saying. What if it implodes tomorrow? What happens when everyone dumps all their money into one investment, right? There's no regulation on it. SEC is not looking at it. Heck, FINRA doesn't even know what's going on with this thing. So you're dumping all your money into something that's not even secure. No one knows anything about it. No one really knows how it works, but it sounds good. It's valued at $11,000 over here in the States, $15,000 in Canada. God knows how much it is in euros in Europe, right? So everyone's dumping their money into this thing, but it's just as terrible as if you were to stand in front of somebody who has a full-blown flu and you just got the flu shot. Think about that for a second. You just got the flu shot. Someone has a full-blown flu. They stand in front of you. They sneeze right in your face. What do you think is going to happen? You're going to get sick.
You're going to get sick. Yeah.
So that's what I think about Bitcoin. I mean, it's not even tangible. It's not even tangible.
That's what I was afraid of. And again, I'm very conservative, and I need to see where my money is coming from. I told you how many times I call a bank just to make sure my calculation in my brain is right. Right. So a lot of anxiety built up when I heard about this, because there was so many people talking about it, so many people saying, get on this, do this. And then when you see the numbers, it's like almost eye catching. And it's like, wow, this is going really, really fast. This is something I should get into. But on the flip side, it's like, okay, wait a minute, that seems like a danger zone a little bit. So I just keep inquiring and keep asking around, and thus far you guys are the only three that has said it's a danger zone. So I think I'm going along with three for three tonight.
We did agree on something
with the danger zone. Absolutely. No, we agreed on a whole lot. I've learned so much tonight from these three perspectives, and I'm sure that the viewers and supporters have as well, because they're asking also about Bitcoin. So in closing, I want to make sure, Corey, that you mention your book and how people can reach you and your future endeavors, and then I'm going to pass it to Greg and Marlon.
Well, thank you so much. And interestingly, it's a weird situation. The book, we just finished a big major launch, so it's not going to be officially, it was kind of a pre-order launch, and so it's not going to be officially available again until January. But if a person goes over to thebookofwhy.com, they can both sign up there and learn more about when it does come back out again. And I mentioned that I spend most of my time speaking, so I also teach other people how to get into the speaking business. And listeners and viewers can learn more there learn more about that at thespeakingprogram.com. It's pretty easy, thespeakingprogram.com. And and it was just a pleasure to be involved, and excited to see where this all goes, and to wave the flag for the show. And thank you so much for bringing me on and helping to make the magic happen today.
Absolutely, absolutely. And I'm so happy that you're actually a part of the magic. This was definitely a magical conversation, and I'm 100% grateful that you called in all the way from Canada. You made time for us, which is extremely important. We need to continue this conversation at the table about financial literacy. So thank you so much for the support and love. We appreciate that. Greg?
Thank you.
Well, all I can say is the first million's the hardest. After that, it's easy.
Okay. That sounds a little painful.
Currency trading is tax-free, so if anybody actually wants to get engaged in currency trading, let me know. But I think the big perspective is time. Our asset is really time, and who you spend your time with, and how you spend your time, and the people that make you feel best are more valuable than gold, Brent crude oil, or anything. So I have nothing to promote except that we continue to love each other. The politics in this country have made it nearly impossible to communicate, and communication is an asset. So
that's right. And we have to keep the flow of communication and that interpersonal relationship going. A lot of people are losing that, and we're so focused on technology and things like that. We're losing that interpersonal, that kinetic energy between humans.
And I think.
Did you see the dancing robot? Oh, we don't need to talk about that, right? No.
Drones. I have a significant drone investment.
Oh.
I'll say.
Really?
Yeah. Drones are definitely another issue.
Okay. All right. So Marlon.
Well, if you want to reach me, it's pretty simple to reach me. First of all, I want to thank everyone here for just being here today, and all of us sharing the information that we have, because it's so critical to teach everyone in the communities about this information. Once again, thank you to FLO Empire Radio for having me on. If anybody wants to go into the financial realm, whether you want to become an insurance agent, whether it's be life insurance, health insurance, if you want to become a stockbroker, I can help you with that as well. Because I do coach those individuals in Series 7, 6, 66, 63, 65, and oversee and supervise those guys. So if you want to get into that field, you can definitely reach me. You know what? I'll just throw out my business number there. It's attached to my cell phone, so you can reach me directly, right? Rather than giving an email or a website or something. It's easier to find us, Partners in Truth, on Facebook. But you can definitely reach me at 646-580-5903 if you want to take the career route of financial education, financial literacy, and going into the financial community. Also, if I may, I wanted to also let you know there's two people that you can also reach out to as well. In addition to myself, if you don't like coming to the Bronx, but you want to stay in Manhattan or something like that, you can reach out to Dr. Maria Smith, one of my colleagues, and she's in Harlem. So she's also graduated my financial literacy class twice, as a matter of fact. And also Wayne Cook, my co-founder for Fortitude SES Incorporated, if you want to become a real estate agent or a broker. You can do either one. But just reach out to me for sure directly. I will always pick up my phone for you, and even if you're a perfect stranger, I'll gladly talk to you. So
good stuff. So I'm gonna turn the mic over to Todd temporarily because something happened with my system, and I just want him to give a shout out to everyone on Facebook and social media who's been tuned in to buildingsafercommunities.com/radio.
Shout out to Eric Johnson. Save 10%, give God 10%, and we'll all be well.
Mm-hmm. That's good advice.
Shout out to Sean Mason. Bitcoin, he said he was going to Google Bitcoin. He said Bitcoin is starting to sound like an old pyramid that we used to jump on back in the old days. In order to get paid, you had to be sure to be one of the first to jump in on it, or you would lose your money. Mm-hmm. Shout out to Daniel Ajawa, Alexandra, Mario Matea, Delia Cuevas, Tanya Brown-Stowe, Alex Williams, Pam Mortis, Mike T. Nilsson, Tony Stallings. Thank you, whoever else called in.
Mm-hmm. And I see Lawrence Johnson. I see Pam Shepard. Danielle is on. You said Sean Mason. Okay. So thank you so much to the viewers and supporters who have been tuned in for this very, very, very essential conversation. And again, like I said when I did the post earlier, that is ongoing and a continued conversation. So for now, we want to make sure that we are saving anywhere between 2 to 15% annually in regard to being on that track for financially. In addition, we want to make sure that we're putting investing our money in appropriate places. And where are those places again?
I could tell you I'm long Philip Morris and Kroger.
Marlon, so
Stay away from oil.
CDs, bonds, stocks.
Well, I would say
And
try to avoid
insurance.
CDs, but definitely insurance, definitely IRAs, definitely stocks, bonds, municipal bonds, preferably if you can afford it.
Okay.
I mean, there's so many different areas. I mean, the most important investment is yourself, for sure.
That's right. That 10%. And Smith and Barney, is that still good?
Absolutely. Yeah,
Okay.
I would say
Wonderful stuff.
there's a net worth too. Everybody has one. It's to the exact dollar. Calculating your net worth is the first step. Figuring out what that net worth is. All your assets minus your liabilities. If it's negative, so be it. But it has to go up, not down. That's the most important part. So I
Absolutely.
think that's the first step. in
Corey,
terms
you
of
still on the
financial
line?
literacy.
Yeah, absolutely.
All right. So we're tuning out. So I just want to say thank you so much to the three wonderful speakers today. This was definitely an insightful conversation. Let Todd say something really, really quickly.
Yeah, I wanted to say once again, condolences to Serrano Colvert, who was an avid caller and a supporter of our radio show, and he always called and checked in on us and had good words to say. Shout out to Blondie Blackwell, who was a co-worker of ours, and I've known the lady almost 20 years and a sweetheart, and condolences to her family.
All right, so you've been tuned into buildingsafercommunities.com/radio. Questions, answers, and solutions. Thank you so much to the viewers and supporters. Again, tomorrow, December 6, 2017, is our 1-year anniversary. Thank you so much. XOXO. Good night, everyone.
Hey.
All right, Corey, good night.
Take care, Corey.
Good night, Corey.